Thank you everyone for joining this presentation of the European Opportunities Trust, quoted investment trust on the London Stock Exchange. Delighted to have this opportunity. I'm going to talk for about 20 minutes and I'm going to cover three major sort of topics, if you like. One is talk a bit about our company because that is vital because it's the important platform. I'm going to explain what our offer is. And thirdly, I'm going to explain our current positioning. But before I do that, I just want to draw your attention to the title of this presentation, Consistent Investors. I've been doing this job for 25 years. I've got an excellent team, and between us, we deliver a totally consistent product. What I tell you today is what I do, it's what I will do, it's what I have done. And I hope you understand how important that is because, and if we just flip to the next slide, please. I have a very good long-term track record. I started managing this investment trust at the start in January 1999, and we've had some ups and downs, and I'm going to show you a couple of downs recently. But we have always prevailed. We have performed well. I have performed well, and that's through consistent investing. I have a style, it's worked before, and I believe it is particularly good in terms of timing now because I've always done well coming out when the bubbles burst, we've done well, but that's just a matter of historic record. So if we just flip on to the next slide, please. This shows the long-term track record or some of the long-term track record, and it shows you I haven't done well recently. I've done badly recently. However, I do believe now is the time because, as I say, always do well after the bubbles burst. Always do well by having a consistent approach. And I believe above all, it is an appropriate approach, which I'm going to explain to you. But just a word on why I've done badly recently. There are two reasons. One is, which we might want to talk about, is I invested in Wirecard, which was a tremendous mistake. But I think more importantly, when the COVID problem pandemic struck, I believe that the policymakers' responses in the West, including America, were very dangerous. Cranking up QE and believing the Build Back Better dream. I did not believe it. And at that time, I sold a lot of retail facing stocks. I think I've been completely vindicated now, and I'll come on to our current positioning. But the fact that we sold a lot of those retail facing stocks because I believe a consumer squeeze would come and inflation would come, turns out to be the right way to be, but I was much too early. The COVID era was a period of irrational exuberance, and I wasn't sufficiently optimistic for that time, but I stick to my guns. So we'll move on to the next slide, please. And I'll explain just very briefly about why, together with two colleagues, my partners here, we left a mainstream house 3 years ago. I had wanted to leave sooner, but it was difficult to get out. The main reason is that the mainstream houses lose focus on their core and only job, in my view, which is to try and make money for you, legally. Of course, that goes without saying, within the boundaries of, I'm here to try and make money for you. That's all my job is. I'm not a social worker. I'm not a moralist. I'm not meant to do anything else. I'm meant to try and make money for you. And incidentally, all my family money is in this investment trust with you. So I have a true alignment of interest. That I see is our role, and we do not get deflected from that core purpose of trying to make money for you, our customers. And I think the mainstream finds it very hard to do that because they have all sorts of other agendas. But at Devon Equity Management, we had a complete and unremitting focus on that core purpose. And with that, we have an excellent platform. I have high quality colleagues. I have a high quality independent chairman. We have a dedicated CEO who I worked with for 18 years at my previous employer. So I and the investment team can focus completely, solely and wholly on the investment job. Next slide, please. You might want to come back to it, but here is our lean, focused, high quality organizational structure. And we'll flip to the next one. You might want to come back to it later. Just shows the team, the core investment team. Right, we'll move on to the next slide, please. And I just want to show you just about investment conviction. What do we do for you? It's all about special companies. And a special company, as I see it, is one that has the ingredients for success, is properly independent and can flourish in different economic scenarios, because we don't do macro forecasting. We also expect a special company to be one with some kind of unfair advantage, which might be market structure, it might be a particular technology, and can grow longer and stronger with higher margins than the market realizes. That is where we've made our money before. We are not investors in Europe. We are investors in great European companies that compete and succeed on the world stage. And I'll come back to that because that is vital. And just move on a slide, please, to our offer. Again, only working for you. We don't work for the government or other stakeholders. We work for you. We do it by investing in a collection of around 30 special differentiated companies. We understand real world risk, and we have these companies in what I call single company uncorrelated risk, by which I mean, if one of them has a problem, it doesn't affect the others. These are quite distinct, separate investment opportunities. That is very different from a portfolio that might have been constructed on having lots of oil earners or lots of dollar earners or a play on Germany. We don't do that. We invest in specific companies which do a specific job for us and largely unaffected by any of the other companies in the portfolio. So that's our offer. And we'll come back to that a bit more. And on the next slide, please, I want to explain some of our thinking, because we hope we have a fund for all seasons. Our investments are specific bottom-up companies. We invest in companies, not stocks. And what that means is it's a mindset, because we hold companies for a long time if they're good. For example, I bought Dassault Systèmes in June 1996, and indeed for this trust in 1999, and I've owned it every day since. So that tells you something about, we're not churning, we're not speculators, we're proper investors. I don't do regular normal macro, by which I mean I don't spend any time looking at whether to believe the IMF's forecasts on European GDP, because I don't believe their forecasts and never have. It's not what we do. But what we do is we understand what I call the super macro, recognizing structural decline in Europe, that's important, recognizing the energy crisis in Europe, that's important, understanding the inflation problems is important. But we can mitigate these, we can sidestep these to a very great extent by the positioning we have, which is intellectual property, not capital intensity, global opportunities, not just narrow geographic opportunities. We're very excited about the opportunities we have because these are specific winners. That's what we look for. So I'm not unduly worried by the problems, say, of Europe, because we can find good opportunities in many geographies, including Europe. Let's move on to just with a risk mindset. I just think it ought to be able to say that and this comes down to sort of screening, understanding real world risk is vital. And we do this by having profitable business, highly profitable, established businesses. And actually, I think we'll move on to just one more slide just to show this. The long-term structural trends, this is where the risk aspect is so important. We measure all companies, or benchmark them if you like, by these key disruptive drivers. And the key disruptive drivers can be regulation, technology, or changing consumer habits, and a mixture of those, because the one will drive the others. And with our risk mindset, we look, can any of our companies or any of the ones we're looking at be damaged or disruptive by these forces? So we look first at the downside. And if we're satisfied that we don't see easily recognizable, realistic disruption from those three, though we must always remain vigilant, we flip it around and say, but can we be winners from these? And that is where our opportunity lies. Multiple upside, optionality on strong franchises where we don't see them being disrupted. Rather, we see them being winners from disruption. I'll give you one very simple example, if I may. Think of digital, or virtual experience. Everyone will talk about it. We used to, but no longer because of the COVID and retail crisis, invested in Carnival Cruises many years ago, a great business model. Can that be disrupted by a virtual cruising experience? Not really. It can be massively enhanced by the use of digital technology, but I don't believe that the core experience of cruising is disrupted by the virtual experience. However, contrast that with, say, retail. Retail has been massively disrupted by the virtual shopping experience and by digital. So it's a way of saying we always deal in specifics, and simply saying digital doesn't give you any answers. Digital means for some people it's a winning opportunity, and for others it's a tougher opportunity, a tougher challenge, lowering barriers to entry and introducing new entrants. So we always try and deal in specifics. And if we can flip to the next slide, please. All our 25 to 35 companies in our portfolio share certain characteristics. We're always looking for the same pattern. We're looking for companies who, as far as reasonably possible, control their own destiny. They have structural advantages, multiple real barriers to entry, and I'm going to give you a couple of examples at the end of the presentation. They have pricing power, they have repeatability, they have recurrence, and we believe they are winners from the structural, the disruptive drivers I talked about. They're all profitable and proven and fit my criteria of special companies. Thank you. This just illustrates one of the things we're very attentive to. We have profitable, very cash generative companies, and even so, our companies have less debt than the average. It's important because I'm terrified of the debt problem out there. We have better quality companies who are going to have an easier job refinancing at lower rates, and they've got less debt. This is a good place to be. In general, of course, I have exceptions, but I'm talking about the portfolio all in the round. A quick word on Europe, or we can move on. Europe is a structural underperformer. I'll come on to that. So, but just on the next slide, I just want to show, when I talk about our companies competing and succeeding on the world stage, these are the numbers that show it. If we divide the world into North America, Asia, and Europe, you can see the split in see-through revenues. So we don't target particular geographies. We target great companies, and their expertise will take us where the opportunities lie. But it's not a great surprise. They're global opportunities. And the great thing about this is, not only is the total addressable market so much greater, but if you compete and succeed on the world stage, it is a proof of concept. It's a validation of the business in which we're investing. So I think it's both from a risk point of view, looking at the downside, good, because it's a validation, and it's great risk from the risk reward on the upside, because we have a much bigger addressable market. Again, I'll come back to an example at the end. On the next slide, I just have we might come back to it later. You know, the European Commission has just an extraordinary record of failure, which is why we never bought into the COVID Build Back Better Green Dream. And I think it's shattered already because of the energy crisis. But my skepticism on this is important, because we invest in great companies. We don't invest in dreamy stuff from politicians. Let's get back to the EOT positioning on the next slide. Less debt, lower energy bills in our portfolio, because we are much more, and I'm on slide 16, sorry, I do apologize, on slide 16, much more about high intellectual property. This is, in certain senses, cheaper than buying in lots of expensive metals and energy. And we mitigate the problems of any regional geographic risk by being all over the world. And just a word on our what I call the B2B. We have many businesses which are effectively business to business models rather than business to consumer. And within that, just very briefly, I'll just comment that we like companies who have something special and different, and they can measure it. And if they can measure it, can they then monetize it? That's to say, can they prove to their customers they're better, their product or service is better? Are their customers willing to pay for that? And do the customers have the money to pay them? Again, I will give you an example at the end, but another one example might be, think of buyers seed corn in America. In a simple way, if you have corn seed which grows faster than anyone else's, the farmers understand that and they pay you more for it. Can they afford it? Yes, because farmer profitability is so high at the moment. It's a simple way of understanding it, but it's all about risk mentality. I'm going to go very quickly because I'm nearly at 20 minutes and I don't like overrunning too much, but I'm overrunning. So let's go to corporate governance. We've been interested in corporate governance from the outset. Company culture is key. We have to have companies that are successful in their products and services, and you can only achieve that if you're a nice place to work, if you treat your customers well, if you treat your staff well. You don't succeed if you don't treat people well, treat customers with respect by providing them with excellent products. So I know all this. Then the regulator comes along on the next page and says you must do ESG. Well, we do what the regulator says. We have to do what the regulator says, and we do what the regulator says. But we were there a long time before the regulator. I have two slides which we're going to pass over very quickly. If you're interested in things like greenhouse gas emissions, don't be surprised that they're very, very low in this portfolio. We don't target that, but we have a lot of intellectual property. So it's completely irrelevant to us. But for those interested, the numbers are there. But I'm going to go on to slide 21, because this shows why ESG can come at a cost. A lot of great companies and a lot of great executives say, we don't like the way we're treated in the public market, so we go private. And this is something we should all care about, which is why in my engagement with companies, I try to be reasonable and I try to be understanding and understand the real world. I do not want to drive great companies into private equity and away from, we want publicly quoted high quality executives and companies. And that's what we have. It is also one of the reasons why we invest in ICG, because it's a way of getting some of this enormous fundraising in private equity. Investment themes on the next slide. I don't target investment themes, I target great companies. But if you work back from what we picked, this is how I might summarize it. But the more important point on this slide is we are not all things to all people. I do not seek to give you a balanced portfolio with banks, commodities, real estate, energy. We don't do that. We absolutely don't want to do that. We are trying to find an unbalanced group of special companies, high margin, with certain advantages, which I believe means you can get better returns in the long run. And here are the two, I promised a couple of examples, so here we go. Our biggest holding is Novo Nordisk. Novo Nordisk is almost a world duopoly, quasi-duopoly, in the treatment of two massive therapeutic areas, diabetes and obesity, and we're just starting that in obesity. They operate worldwide. They have multiple barriers to entry, whether it's manufacturing scale, whether it's branding, whether it's the network of nurses and key opinion leaders, whether it's the requirements of the FDA or indeed the Chinese authorities. But if you are, along with Eli Lilly America, one of only two companies which has state-of-the-art GLP-1 technology, which is delivering amazing therapeutic results, and coming back to measurable, monetizable, selling to people who can pay, governments and health authorities understand that the benefits of these drugs are very good value for society and for the healthcare authorities. Simply put, the obesity drugs now produced by Novo Nordisk, which can, for people with 80 kilograms, obese people, BMI of over 100, the studies show reduce body mass by 17%. There are huge benefits in that. The next iteration of their drug will be more like 25% weight loss. This is coming and it's very big. So it's just one example. A final example, Deutsche Börse. It's a special financial company. It is a beneficiary of higher interest rates. It is a beneficiary of financial uncertainty because people want to deal on exchange with market participants they can trust, and they can trust them because they exchange guarantees. This is a really strong business for us to be in and fulfills all our criteria. So I've got one final slide in conclusion, and then I'm only 5 minutes overweight. We are consistent investors. I'm going about it the same way with a better quality group of colleagues than ever before. We've been here many times before, and I feel the timing is good. There are always going to be great investment opportunities. However bad the recession is, there are going to be companies come out much stronger and take advantage of it. The great businessmen, the great entrepreneurs always see the silver lining and always can see an opportunity. And we try and find those great companies, those great enterprises, and we get on their coattails and hang on. So I think we're well prepared for the new challenges. We are absolutely consistent in what we do, finding great companies that happen to be listed in Europe. We do it with a risk mindset, and I'm very comfortable, very happy with what we hold. So that was all I wanted to say now, but I'd be delighted if there are any questions, please.
Thank you very much, Alexander. That was really interesting and insightful. And I have a lot of questions for you. So I'll start at the beginning. From Andrew Lato. What was the reason for leaving Jupiter, and does your new firm have equivalent research resources?
Okay, so I couldn't stay where I was because I didn't enjoy it at all, because I'm an investor and I'm here to do one job for you. So when I get thwarted in that process, and I'm sorry to say I was thwarted in that process, because that's what mainstream, I don't want to talk ill of my previous employer, but they have different agendas and I don't. I have one simple agenda, which is trying to invest well for you. So that, and I can build a team here, which I was unable to do there, of like-minded people. We're all on the same side. We don't have politics here. We don't have bureaucracy here. And I don't want to play playing office politics because it's a distraction from the core business. So no one has to work here. If they work here, because they enjoy it. That wasn't true in the mainstream. So I'm very, very happy. Coming to resources. Honestly, much better here. I think my previous employer had a very good bond team, and I think there were some people there whose insights and thoughts I would miss. But beyond that, I have a bigger investment team here than I've ever had before. We are more focused than ever before. I don't have to worry about other agendas. I don't have a politics problem. I have an excellent CEO who does all the boring stuff for me and does it very well. So I'm very happy, but I don't know what more I could do to prove that. I don't have to do this job. I do it because I like winning, and this is a great platform. But if you ask me, I've got no excuses here. I have everything I need. I have excellent corporate contact. I have excellent access to companies. Many of them and the broking community know me and believe we are reasonable, high quality investors. We run a significant amount of money already. We get good quality access and we work very hard at it. So I'll give you one final thought. Throughout lockdown, me and my colleagues chose to come into the office and work together. Other places were shut. It's a cultural difference. We care more.
Thank you. And you have another question from Andrew. Did the investment in Wirecard highlight any weaknesses in the investment process, and has the process been changed?
The obvious answer is yes, because I made the mistake. So I got it wrong. But I want to tell you the reaction. And so there are many things to learn from it. One of them, I'm afraid to disappoint you, is some of it is unavoidable. There is always a risk. However, there is some good news here. The reaction to this Wirecard trauma has not been that we've retreated into becoming an index fund. We want to take good quality risk for you. So are things different? And I think I can demonstrate to you. I'm going to take the example of Darktrace. Darktrace came to the market and we thought it was a great opportunity as a company. It came with a health warning because of its association with Mike Lynch. I've never invested in Mike Lynch or autonomy. But here are the things. So the first thing is the fact that we were prepared to consider it and indeed invest in it shows you I haven't lost my appetite for good quality risk. That's the first thing. The second thing is, as a riposte to the Wirecard problem, I said to my two investment partners, Luca and Charlie, you can veto, you can stop me doing this if you think there's a problem here. So I gave them a veto, which had never happened before. And they both said, we are comfortable, we did the legal due diligence, go ahead. So we did go ahead. But there's one obvious example of a change. My colleagues much more involved and had a veto had they wanted to exercise it, and they can. Don't worry, they're strong people. They're not worried about me. If they want to do, they can. The third thing is, I think the Wirecard experience crystallized something which is very useful in terms of weighting. I think there are great companies, there are good companies, and there are exciting companies. And Wirecard was exciting. And we have now a much lower weighting for exciting companies than a great company. I think, so I'll just do a compare and contrast with Novo, which I think is a great company. Novo Nordisk, for it to be disrupted, you would have to have years of FDA clinical trials. The same is not true, so you get lots of warning. The same is not true with a company like Darktrace, which is in cybersecurity. They could be very quickly disrupted by someone who we've never heard of before. There could be a genius, a Bill Gates type could come up with disruption. It hasn't happened yet, but we need to be nimble, and we need to recognize in our weighting and the quality of the business that until it becomes embedded or recurrent in some way, which is not the case at the moment to us to a very high level, it's exciting, and that's reflected in the weighting. So I hope that answers some of the question.
Thank you. Now, a question from John Gullidge. The position in Wirecard was particularly large, which magnified the fall in the fund when it failed. Have you reduced the maximum size of speculative holdings since?
Well, I think I've answered some of that question, but I will just complete it by saying that for any holding of more than 10%, we do not buy any more shares. So that is a partial answer, Joe. But if you look at the shape of the portfolio, and I think you have it in this presentation, the appendix, you can see for yourself what the shape of the portfolio is. But I think I've answered that.
Right. And then Andrew, again, the performance fee was scrapped previously. Is it safe to assume it won't be reintroduced?
Well, it's not my decision, but I think it's very unlikely it'll be reintroduced. I mean, it's not my decision, that's a board decision, but there is absolutely no discussion around that. That is a new question for me. I mean, no one would consider it, so I'm slightly surprised. No.
Thank you very much. And now a question from Andrew. You have a fan here. European stock markets have significantly underperformed US or global stock markets. Doesn't this undermine the case for a Europe-only fund?
Well, as I've sort of demonstrated, only around 1/3 of sales are in Europe. And of course, even within Europe, there are very, very successful companies. So we can't write off every investment in Europe as being bad. I mean, take Deutsche Börse, which is essentially, but not only, a European business. It's a big beneficiary of uncertainty, volatility, and indeed higher interest rates. Well, don't worry, you're getting higher interest rates in Europe. I don't think it does undermine the case for Europe. Our biggest holding, Novo Nordisk, its biggest single market is North America. Eli Lilly is more highly rated. That I can't really explain. What I can show you is the returns I showed you on the earlier slide from the outset. You can make a lot of money with this strategy. I'm not saying you can't make more elsewhere. I'm sure you can. Almost by definition, you're going to find there are better ways of doing it. I'm sure whether you can find them and get them right, that's another matter. But what I can demonstrate on that first slide that you can make very good returns with this strategy over the long term. I've demonstrated that.
Thank you. There's obviously concern about higher energy prices. And in fact, the next question asks, aren't higher energy prices a headwind for European companies?
They might be, but I don't invest in all European companies. higher energy costs are not a particular problem for me. And that's partly because, for example, we have, I know, Experian, our second biggest holding, its biggest market is in North America, where they don't have an energy crisis in the same way, because the Americans have a completely different energy policy from Europe. The European political class, including the UK, have brought an energy policy upon themselves, frankly. But we are low energy users. As I explained at the outset, we are much more about intellectual property. And so, yes, we have an inflation problem with software engineers becoming more expensive. That I would accept. But our energy use is very low and is well below the average. We have very little costly, energy-intensive, transformative businesses. I don't have them. We don't have those kind of businesses typically. But again, just look at the top holdings and you can see what they are. They're not big energy users.
There's the acquisition of Monsanto by Bayer is well known. The question is, wasn't Bayer's acquisition of Monsanto poor?
Well, it's been in certain senses very poor. They paid $65 billion to create, along with what Bayer had already, the best crop science business in the world. And that was a brilliant move. The problem is, frankly, a purely political one. The Americans rubbed their hands together and said, right, we'll fleece these nasty Germans. And that has cost Bayer about, call it, $16 billion in provisions for Roundup in America. I think personally, I think it's unjustified, but that's just how it is. So if we take that 65 billion and the 16 billion of provisions for an acquisition made 4 years ago, in one sense, it's been very bad because of that 16 billion loss. However, two really important points. One, if you were buying Monsanto now, you'd be paying $16 billion more anyway, because there's been, partly because of QE, there's been a re-rating there's been asset inflation since that time. So it was a mistake in that sense, but probably has washed its face with asset inflation. But the much more important point is, I believe they have been absolutely vindicated in terms of having, without doubt, the world leader in crop science. And they're making a lot of money in crop science at the moment. It is a vindication of what they're doing. It is the best in the world at what they do, and very hard to disrupt. So I think it is a terrific investment. It's on a very, very low rating, but I think it's a really strong investment.
Thank you. Another question. Is there any succession planning for when you aren't running the trust?
Well, I intend to keep going for a long time, but what I can tell you is, and you'd be welcome to asking my colleague, this company from the outset has not been about me. We call it Devon Equity Management because we're a team of people. We're a partnership. We have other equity holders, and I work very hard to put myself in a position where someone better than me can take over. So I will be very, very happy if there's someone better than me take over, but I have absolutely no plans to change. I'm here for the time being and enjoying it. So I have no retirement plans in mind, but it would give me enormous satisfaction if one of the team, they're all younger and brighter than me, turns out to be better than me. I'd be delighted. Wouldn't worry me one bit, but I'm not going.
Jolly good. The next question is from Bill Hall. Why do you think the long-term returns of Deutsche Börse will be better than the London Stock Exchange?
But I never said that, Bill. I never said that, and I'm not sure that is the case. I don't know. I used to invest in the LSE and in Deutsche Börse, and actually, if you go back, I guess it's about 5 years, the European Commission was very, very keen on a capital markets union. And Deutsche Börse and LSE were going to merge. And the British and the Europeans said no, and they both got protectionist. The Cameron government was very, very much at fault in that. It would have been an amazing merger. and it would have made that platform a real powerhouse globally, but they decided not to. The response to that, in the case of LSE, was they got some very smart management. I'm really admiring. I know Don Robert, the chairman, very well, and David Schwimmer, the CEO, not as well. I have a very, very high opinion of them. They went and bought Refinitiv, and we sold at that point because that was a very complex, difficult acquisition, made slightly out of desperation. So I have a very high opinion of them. I think LSE is a great business. But I told you at the outset, we have single company uncorrelated risk, and Deutsche Börse does an excellent job for us. I think it's lower risk. It didn't have any of those big acquisition problems. So I've got no problem with LSE. It's just that I'm investing in Deutsche Börse, and it's going very well. Thank you.
Thank you. And for the next question from Neil, I don't have a problem with long-term track record or process, but the performance over the last 5 years has been lacking. What was the reason for the underperformance from 2020 to 2022? What are you going to do differently from 2022? I don't know if you feel
right.
that.
Well, I mean, I think I said earlier there were two reasons for poor performance. One was Wirecard, and one was my undue I think justified skepticism about the build-up in debt, the build-up inflation from QE, and some irrational exuberance around Build Back Better. I think I'm being vindicated now. But if your question is, am I changing course? No, because the title of this is Consistent Investors. I have been here many times before, and you could have said exactly the same thing to me before the internet bubble burst or before the banking crisis, and we turned out to have made good decisions. So look, I'll stick with what I'm doing, and we work harder than before. We have a better team than before, but I am confident in the process. But I have given you reasons why the poor recent performance.
Okay, Bill Hall now. Could you say something about the role of your board of directors and your new chairman? Do they contribute anything in terms of investment ideas, and do they have sizable stakes?
Are you talking about the chairman of Devon Equity Management or the chairman of European Opportunities Trust? I'm sorry, I slightly need to know.
That's a very good question, and I don't have an answer to it.
Do we want to come back? Can we come back to that one, or shall I answer?
Perhaps Bill would like to send a revised question in. We'll do it that way.
Okay, and then I'll happily.
Okay, Benjamin Villiard. MOE has been impacted by regulatory changes just recently. Is it such a good company? Its fate depends largely from the Salmon tax.
You're right. This is a shock. It's the Norwegian government said this is a great profitable business, and it is a great profitable business, and they've just come and stolen the money. So I have a problem. I might wait until we might just see exactly what goes through Parliament, but it is a terrible thing that the Norwegian government's done, and I can't stop that happening. The interesting thing about it is, will the Scottish government, and I don't yet know if the Scottish government has the powers to do the same, but if they can, you bet they will, and that would make it uninvestable. Because the only reason now Movi can be successful is to carry out their threat to the Norwegian government, which is right. We won't do any investment in Norway because we're not wanted, because you just steal the money when we work hard, and we'll invest in places like Scotland and Canada instead. So the risk is that the Scots do the same. So this is, you're quite right, this has turned out from being a really good business to having our money stolen, our money stolen. So we're on the case, but I don't exactly know what we're going to do about it.
Thank you. The next question is from Stephen Pill. Has the trend of escalating antipathy and tension between the Western world and Russia/China been one of your macro considerations? And if so, what conclusions does that lead you to?
Russia is largely irrelevant to our companies. But clearly that's a terrible situation. China is much more relevant for our companies, and China is a more difficult place in which to operate. Generally speaking, as we're in things like IP, Dassault System in its CAD/CAM is kind of below the radar. On the other hand, Experian, because they're doing credit checks, are forbidden in China. So it affects different companies in different ways. But what we don't really have is big factories in China with cars and aerospace. Those are the high profile problems typically when it comes to trade wars. But yeah, I think the deglobalization, the step back from globalization is generally bad for all of us. I try and deal with it on a case-by-case basis. We don't see a problem in China from Novo Nordisk and its GLP-1 and its insulin for the time being. And indeed, Novo will tell you that it is still strongly their view that if you bring innovation, the Chinese will pay. If they're not prepared to pay, they don't get the innovation, but they do value the innovation. The Chinese will try and do anything, everything. If you do it better than they do, they might well pay for it. Of course, so this is a consideration, but I do it on a company basis. Can we come back to Bill's question on the board? Because I don't want to ignore it. I'm going to ignore it.
There's a message here. It just says Matthew Dobbs.
Oh, right. Okay, so this is the EOT board. Matthew Dobbs is very experienced, and I think he's going to be very helpful. But I think my view is, I don't know what the board think, but my view is, rightly or wrongly, I run the fund and the board is there for oversight. And I think they are not there to pick stocks. They're not there to have an opinion about whether I'm picking the right stock at any one time. They're there to do different things. One of them is to see whether what I tell you I do is what I do. So the number of shares, companies in which we invest, the tracking error, gearing, those are things that properly concern them. And then over time, if shareholders tell them they're unsatisfied and they want to change manager, they have a big role to play there. But they do not have a role in picking the stocks. They don't do that. I do that.
Because it was asked some time ago, I'll just go back to it because, in fact, he also asked, Bill also asked, do they have sizable stakes in the trust?
Gosh, well, I only know what is announced, and I don't spend a lot of time looking at it. But I think, funny enough, I think Matthew Dobbs does have enough that he cares. I think he would care, actually. I think he's invested enough that he cares. But again, please don't hold me to that. It's a matter of public record. So one or two of them do, and one or two of them don't have anything at all.
Right. Fair enough. And I'll now go to a new question from Robin Maxwell.
Oh, hello, Robin. If it's the same Robin.
I am very interested by your position in Merck. I have been considering the same. Is that a valuation call versus Sartorius? Oh. And second, how important are annual dividends / share buybacks as part of the investment decision?
Okay. Hello, Robin. It's definitely the same Robin, because he was Robin, you were very positive on Sartorius, I remember, and you've been absolutely right on that. I prefer Merck, not just on valuation grounds. I think it's fair to say Sartorius has got a terrific single-use platform, and probably Merck's is not quite as good. But I think Merck has other things going for it. I think their mRNA platform means that they can bundle it with the single-use and plastic use tools and platform, and I think they will get some benefit there. So I think they can be a bigger partner to smaller companies in mRNA, and I think also the electronics business of Merck is very powerful. I'm less excited about their pharma business. Merck is it's got some terrific technology, and it's not valued as being special. So I prefer more focused companies. Instinctively, I prefer the single shot you get with Sartorius. However, in Merck, we have 2 or 3 excellent shots, at a lower valuation. So that's one thing. Ray, am I right in saying there was a question on EOT on dividends and buybacks after that? Did Robin ask one on buybacks?
Hang on, no, he hasn't asked that.
Was it on EOT or was it on Merck? I can't remember. So I'll answer in the case of Merck. I would like companies to think in this order. If they need money to reinvest because they've got high return opportunities, don't give me a dividend, go and reinvest it in your high quality franchise. However, if they don't have good ways to reinvest the money, please return it to us. And I'd like them to return it to us in the most tax efficient way. And generally speaking, share buybacks are a far more tax efficient way to return capital to investors than dividends. I hope that answers your question, Robin, but I guess I'll never find out if it did or not. The Andrew Latin asks, the dividend in the trust seems to fluctuate and the yield on the trust is very low. Given the focus on growth, is a dividend warranted? Happily, I can tell you it's none of my business. This is a board decision. And I think I'm right in saying that to maintain investment trust status, I think we have to pay a minimum dividend. So I think it's circumstance that forces that minimum dividend payment. But as we are looking for growth and we believe we have good investment opportunities. So as I said earlier, to be consistent with you, I'd much rather we didn't pay out dividends in a tax efficient, inefficient way, and I'd much rather we invested. If you want some money, sell some shares and pay a lower capital gains rate is what I'd be doing. So I think we are obliged to pay a dividend, but it's a board decision, not mine. And I think we pretty much pay as little as we can in terms of dividend. Because if you need the money or want the money, you're better off paying CGT than a higher tax on dividend payment. But as I've never sold a share in this investment trust, nor of my family, then it's not something I spend a lot of time worrying about.
In fact, Bill has called in to say that he really meant to ask about the investment trust and its board and chairman, and whether they had sizable stakes in the trust.
I think we answered that one. I think Matthew Dobbs does have, I don't know what sizable means, but I think he's got enough that he cares. Yeah. And I think Lord Lamont, who's an excellent director, I think he has enough that he cares. But I can't easily remember anything else. One or two don't have any shares of any significance at all.
Yeah. Another question here. How much of your time is spent on managing European Opportunity Trust in trusts investments, and how much on the rest of the Devon asset management business? Do you get the time you want? I think is the question there.
Honestly, I have more time now. No, so I run 3 different funds, but only in one way. They're all run exactly the same way with the same shares. So what I do for one, I do for another. So it's all my time is on this. But as I said earlier, Richard Pavry, the CEO, he and indeed other colleagues like Charles Bilger, they do all the running the business, the back office, the compliance, all that. I have nothing to do with that. I don't want to get involved in that. I just do the investment with my investment partners and colleagues. So I have more time here than I would have done in a more mainstream house where there are all sorts of trainings and distractions. I don't have any of that stuff.
Someone seeking to tap into your understanding of European companies, he asks, are European companies cheaper than US companies on a like-for-like basis? For example, Nestle versus Procter & Gamble.
Well, we had this question sort of earlier, but in a slightly different way. To be absolutely honest, I haven't spent a lot of time thinking of it. I wouldn't want to generalize. I think you're probably right that American companies have higher ratings. However, some of these American companies do amazing things. I mean, you look at the Amazon and Microsoft and so forth. There aren't really European equivalents. The Americans deserve to get paid for their hard work and foresight. You know, there's a reason that Elon Musk is based in America, not in Europe. So I don't necessarily, it's a very, very fine company. I don't know, I wouldn't want to comment on it versus Procter & Gamble. But what I would say is, with Dassault Systèmes, we have a partner to Elon Musk, we have a partner to Boeing, we have a partner to a lot of great American companies. So as long as I'm getting those kind of things right, then I don't really mind if America's on a higher rating or a lower rating. Let's just see if we can get some great European companies, and then you'll be just fine. If I get that right, you'll be fine.
Thank you. I have to say here that Robin Maxwell has called in to say, it is me.
Well, I know it is.
You have answered the question, thanks.
Oh, thank you, Robin.
And another question here. As you said earlier, you now restrict yourself to a 10% maximum size. The question is actually asking, is that a rule of the trust, or is that something you have imposed on yourself?
Well, I think what I said was that where a position goes above 10%, the board of the investment trust has said, I can't buy more. My view on this is, that's fine with me. We'll let things like Novo Nordisk has drifted higher, and indeed I did take some profit at a higher level. But I do not want this to be a UCITS fund. That's to say, run to the same standards as a unit trust. That would be a profound mistake. An investment trust is special. It is for grown-ups. It can have a structure that prevents people from panicking by inflows and outflows. And I think it's really good that we don't run it to UCITS standards. So you asked the question that the not buying above 10% is a board rule, which I'm comfortable with, because it doesn't change the purpose of this investment trust, which is trying to provide a high quality vehicle for grown-up investors.
And a question here. Many investment trusts use financial gearing, including EOT. Doesn't this increase drawdowns and make it harder to buy stocks when markets are weak, because leverage increases when there are sell-offs?
Well, we have a low level of gearing, a very low level, I think about 8%. And I did reduce it a fair bit, and I've taken advantage of recent lower valuations because I do see opportunities. So we're at about 8%. I have to tell you, before the financial crisis, back in 2008, I had very high gearing, and that was a very, very significant mistake. So if you want to know, you've asked earlier, do I learn from mistakes? Well, one lesson I took to heart was never having that kind of gearing again that we had in the financial crisis. As it happens, we came out of that financial crisis very well indeed, because I had a supportive board, and I explained to them that our companies, as is the case now, have less debt and stronger cash flows, and that we would be fine. And when we bounced strongly in 2009-10, I reduced gearing, so we got out well. I don't have high gearing now, but if we see really good opportunities emerging, I would certainly talk to the board about trying to borrow a bit. But we have enough good quality, high quality investment opportunities in this trust already. I don't need gearing to make it more exciting.
Thank you very much, Alexander.